Hi there, welcome to Kneppy Invest. About 3 or 4 years ago, I had a look at the company I'll be featuring in today's video, and as soon as I saw one of their Appendix 4Cs and their cash flow, I immediately said, no, this is not for me, and pushed this company aside. And that company was LiveTiles. At that time, there was a lot of hype around this company because of the growth in revenue. And we did see the share price go on a fairly significant rally. However, things have turned around for the company. And one of the reasons why I didn't take much of interest to LiveTiles was just the amount of spending they did. They loved to spend money. So they were highly operational cash flow negative. And that's okay if that hype remains around and if they can continue to grow their top line, their revenue. However, they went into this period where growth started to slow down, that hype turned around, and we saw the share price move into a downtrend. And that downtrend has continued for about 2 to maybe 3 years. But the company is looking much more attractive now for various reasons. They are operational cash flow positive on the small side. They're also slightly profitable as well. So what they've done is they've continued to grow the top line at a slower rate, but they've maintained their costs over the last few years at a stable level. They haven't increased their costs. And because they have increased their revenue but not increased their costs, they've found some scale. And the most important thing is whether they can continue that in the future. And the valuation of this company right now, if they can do that, makes LiveTiles quite attractive at this point in time. LiveTiles is a SaaS company. They have a platform all about employee experience, trying to improve how employees find their working life, which I do think is very important, not only for employees, but also employers. You want your employees to be as happy as they can be. It makes them more productive and less inclined to leave your company. LiveTiles was founded in 2014, listed on the ASX not long after they were founded on the 17th of September 2015 via, I think it was a backdoor listing, via Modem, which was a mining company, and TVSN. The current CEO, who happens also to be the co-founder, is Carl Redenbach. He has a 9.9% holding. One of the other major shareholders is the other co-founder of the company, Peter Guin Brown. He also has an 8.5% holding. So a nice skin in the game when it comes to LiveTiles. The current market cap of this company is only $80 million. That's at a share price of 8.7 cents. And as I go through the rest of this video, there are a few interesting factors when it comes to this company that makes them interesting and possibly enticing at these prices. And that will become evident when we look at some of the valuation metrics. Quite low for this type of company. And LiveTiles ticker code is LVT. Now, the whole inspiration for me doing this video on LiveTiles was their half-yearly results and their December quarterly cash flow report that they released towards the end of January. So let's have a look at the financial state at the half year, financial year 22. Revenue 26.7, which was a nice increase from last year, 20.3 million. They've also improved or increased their gross margins from 70.3% to 76.2%. Now, when you compare the operating cash flow from last year to this year, you can see the improvements in this company, probably helped by maintaining a constant level of spending and also those gross margins increasing. So they've gone from being operational cash flow negative by 13 million, and there is a reason why that's really high or seems really high, to being operational cash flow positive by 440,000 for the half year. They've also gone from being highly loss-making, $21.5 million loss in first half of financial year 21, to being profitable by $1.3 million in this half year. So this company is looking more attractive when you just look at these half-year results. They have $17.6 million of net cash, which means the enterprise value is in the $60 million range, which makes this company even more interesting right now. Annual recurring revenue is growing. It's growing at a slow rate, but it is growing. And right now, it's at 65.2 million. So just remember, the market cap of this company is 80 million, enterprise value is around 63 million. So if you calculate the enterprise value to annual recurring revenue, that is less than 1. Now, typically when I look at these sort of companies, SaaS companies, originally I was thinking around 10 could be sort of, I won't say fair value, but that's my starting point when I look at valuation metrics. And then I take into account growth in annual recurring revenue, that sort of thing, and then I work my way down or up from that 10 multiplication factor. For LiveTiles, that number is 0.96. So the market is giving this company a massive discount based off their annual recurring revenue. The market, at this point in time, does not like this company at all. Lots of negative sentiment when it comes to LiveTiles, and you'll be able to see that negative sentiment when we look at the chart. But sometimes it's good to go against the herd. It's good to look at a company without hearing what the rest of the market is saying, because sometimes you can find some hidden gems. Maybe LiveTiles is one of those hidden gems. Maybe it's not. It's up to you to decide that. Now let's have a look at some of the interesting things I did find in LiveTiles financial statements from their half yearly. Also have a look at their latest Appendix 4C. Hopefully I'll do this fairly quickly, but a couple of interesting things in their cash flows from operating activities. The first one is these are a little bit different than what we will find in their Appendix 4C. And in fact, the receipts of customers and the operating cash flow of the company should be almost identical because they're looking at the same period. Now, the Appendix 4C is looking at a quarterly period, but they also have the 6-month period, which is the half-yearly period. So there are a few differences there, which I did find intriguing. Now, even though they did improve their cash flow from being negative 13 million to being positive 440,000, they did pay or make a one-off litigation settlement payment of 8.4 million last year. So that difference in cash flows is not quite as extreme as what you see here. So any one-off payments you do have to take into account. Now, even though they are operational cash flow positive 442,000, I also look at whether the company is spending any money in investing activities like capital expenditure and payments for development costs. Seems like that is an ongoing cost for LiveTiles because they spent $2.4 million last year, $2.4 million this year. So I do take that into account. And when you take that into account, and you also take into account capital expenditure, which is payments for plant and equipment, the company is not free cash flow positive. They are free cash flow negative. Now to something that did confuse me when I compared the half yearly to their Appendix 4C. And I'm just looking at the second column here, the year-to-date 6 months. And receipts to customers is a little bit different. So it's a little bit lower in their Appendix 4C at 29.9 million. But the big difference here is the bottom line, the net cash from or used in operating activity. So if you look at this, they were actually operational cash flow negative by 2.4 million, not operational cash flow positive by 440,000. And just above that line, there's two little sections in italics: non-recurring staff costs and catch-up tax payments, 2015 and 2020, and that did account for about 1.9 million or so. But even if you take that into account, they were still operational cash flow negative by about 500,000. So it's really interesting to see some discrepancies between the half-yearly cash flow statement and their Appendix 4C cash flow statement. I thought they should be almost identical, but in LiveTiles' case, they are not. After I've looked at the cash flow statement of a company, I tend to go to the balance sheet. And for LiveTiles, there's nothing really interesting in the balance sheet, and I don't want to bore you. But when it comes to the profit and loss, which is usually the first financial statement in the financial statement section, I always read it last, but it's the first one. So you don't have to do things in order. You can do whatever you want. So revenue, 26.9 million. And they were profitable, if you look at the bottom line, by about 1.3 million. However, and this is very important, there was a fair value movement in contingent consideration that totaled $4 million. And I would take that away. So their real profit for the half year was about negative 2.7 million, not positive. They weren't profitable. In my opinion, they were not profitable in this particular half year because of that fair value movement in contingent consideration. Something else I just want to point out is in their presentation, I think this was in the presentation, They really focus on EBITDA for some reason. I'm not sure why companies do that. A lot of companies focus on EBITDA, but not profit. EBITDA is not a real accounting standard. And to be fair with you, because EBITDA stands for earnings before interest, taxation, depreciation, and amortization. And a lot of those expenses are real expenses. Companies have to pay taxation if they are profitable. They have to pay interest if they have loans, and there is depreciation and amortization. So I think it's Charlie Munger who says EBITDA is BS profits, and I tend to agree with that. I wish companies would focus more on profits, not EBITDA. But this company did focus on EBITDA in their presentation, and they worked their way backwards here, going from underlying or net profit. So they started with the net profit, which was 1.8 million. In fact, it was 1.3 million. But they, for some reason, took tax away from this and started with 1.8 million, because the whole definition of EBITDA is earnings before interest, taxation, and for some reason they started with that 1.8 million, which did not include taxation, and they added back finance and interest charges, 331,000, amortization of software development costs, 172,000, and depreciation amortization of intangibles, 2 million. So EBITDA for LiveTiles was $4.3 million for the year. However, and they did mention this, there was that change in fair value of that earnout consideration, about $4 million. And what they've done is taken that away from the real EBITDA or the underlying EBITDA, but they've added back unrealized currency gains of 395,000. So that underlying EBITDA was only $1 million. But again, I do think you have to take into account taxation, finance and interest charges, amortization and depreciation as well. And if you take these into account, the company was not profitable for the half year. Now to the cash receipts history for LiveTile. So I'm looking at quarterly cash flows or quarterly receipts from LiveTiles going back to when they listed on the ASX way back in 2015. And for about a 2-3 year period, this company was not growing all that quickly. They were growing, but they did grow receipts from 260,000 in that first quarter to $1.1 million 2 years later. So there was a slow growth there. And it was around that time where we started to see a fair bit of hype in this company, and we saw the share price really take off. And receipts started to take off in 2018 and 2019. In fact, receipts grew from 1.1 million towards the end of 2017 to 10 million in the December quarter of 2019. And receipts have continued to grow from there. They've grown to 15.3 million in the most recent quarter. But the market doesn't like the growth in receipts and the growth in our recurring revenue. It believed it should be growing it quicker. But there are some things to like about LiveTiles. Receipts are growing, albeit you might say slowly, but they are growing. But the other thing to like about LiveTiles right now is their cost, their spending. We'll have a look at that as well. So on this side, what I've done is gone to a Digger and just brought out all the spending they've made in general and administration. So this is most of their spending, and also looking at revenue and cash flow from operations. So the spending here is the one I'm focusing on. That's in the green. And during 2017 into 2018, we saw a massive, or LiveTiles saw a massive increase in their spending from about 3 to 4 million all the way up to 25.7 million. And that was in the first quarter of financial year 2019. In fact, in that particular half year, they spent $26 million, yet only had revenue of 5.7 million. So they were operational cash flow negative by almost $20 million. And at that point in time, this is when the hype in the company started weighing away. I think a lot of investors saw the massive increase in costs, saw the company was highly operational cash flow positive, and that's when they started to become less and less interested in this company. But one thing you'll notice since that particular half year, which was about 3 years ago now, spending has gone sideways. In fact, spending in the most recent half year was 23.6 million, lower than that level a few years ago. But the other thing to take into account is that revenue has increased from 5.7 million to 24.7 million. So this company has found scale. They have found some operating leverage, and they are on the verge of becoming, I think, consistently profitable, consistently operational cash flow positive. In particular, if they can continue to grow revenue and recurring revenue and maintain that cost base at what we're seeing right now, or at the very least, don't increase their costs at a greater rate than their revenue growth. If we do see that, I think that the market will become interested in this company again. And we've started to see the first signs of that when the company did release their half-yearly report. Now onto the charts for LiveTiles, and the first chart we're going to look at is their weekly chart going back to when they listed on the ASX in 2015. And the hype in this company was really only in 2017 and 18, and during those 2 years, the share price of LiveTiles increased from 12 cents to a high of about 76 cents, which was in August 2018. You can see a fair bit of volatility 2018 into 2019. In fact, the share price went from 76 all the way down to 28 cents in 2018, and then rocketed up from 28 cents all the way back to 62 cents in 2019. So a lot of volatility. The market didn't know how to probably value this company. That's why you saw the share price swings during that period. But the share price has been in a well-defined downtrend since about July of 2019. So about 2.5 years, the share price has been falling. And right now, the share price is at an all-time low, or near an all-time low, at 8.7 cents. But when you look at the daily chart, there is possible signs the share price might be turning around, or the sentiment starting to shift in the company. Now onto the daily chart for LiveTiles. This goes back to June 2020. So about, 18 months or so, maybe just above 18 months of history here. And from June 2020 to the start of 2021, share price of LiveTiles was trading in a range between about 30 cents and 19 or 20 cents. And then at the start of 2021, the share price of LiveTiles moved into a well-defined downtrend and it's fallen from about 25 cents to a low of 7 cents, which reached the day before they released the half-yearly report. But the market did like the half-yearly report. In fact, the share price increased by more than 20% on the back of their half-yearly from 7 cents to 8.7 cents. But the most important thing, we did see higher volume. In fact, the trading on the day, or the volume on the day, was the highest volume we've seen for this company in over 1 year. So there is a reinvigorated interest in this company based off the half-yearly report. However, because the share price has been in a downtrend for a long time, the majority of shareholders in this company are underwater or are in loss. So you will see a lot of shareholders who want to sell out. And the share price starts rising, they'll see the opportunity to sell out. So there's going to be a lot of resistance moving forward for this company. So the best scenario for LiveTiles is a good period of consolidation. You don't want to see the share price rise too quickly because you'll see a lot of selling coming in, taking advantage of that rapid rise in share price. The best thing that will happen is a consolidation period. So those shareholders who are underwater become sick, become impatient, and they will sell during that period. So if we see a year-long period where the share price just goes sideways, eventually we'll see a breakout in the share price. And most of those shareholders who want to sell out probably have sold out. And that is the strongest sort of move this company can make moving forward. And preferably that breakout in the share price we do see in the future will be on the back of some positive financial news. So that's what I'm looking for with LiveTiles. I don't want to see a rapid rise in share price right now. I want to see a long consolidation period. That's all I have for this video on LiveTiles. Is this company a buy right now? Question mark. I'll leave the answer to that question for you to decide. I think LiveTiles is definitely looking more interesting right now based off their most recent quarter, or last 2 quarters in fact, and their most recent half yearly. And if they can maintain a control on their cost and continue to increase annual recurring revenue and their revenue, they will become profitable on an ongoing basis. They'll become operational cash flow positive and free cash flow positive on an ongoing basis. And that's when I think the market could become interested in this company again. But I'll just wait until that point, wait for a breakout in the share price, and hopefully that breakout comes after a long consolidation period. So if you have any questions about this company or any other companies on the ASX, just leave in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.